Good day. So today I would like us to do a question concerning cash flows. Now I don't want to waste any of your time, so let us start. So the question says that Havana Company Limited has availed you the following information to be prepared using IS 7. So they have given us Havana Company Limited statement of financial position. So they have given us 2024 and 2023. So we have assets, equipment at cost. We have 160,000, and then 2023 there's none. Then equipment that made depreciation have 16,000, and 2024 don't have anything in 2023. Then land is 180,000, then 80,000 in 2023. Inventory is 130,000 2024, and then 2023 is 160,000. So we have accounts receivable 12,000 2024, then 15,000 2023. So we have prepaid expenses 6,000 and 8,000. Cash 191,000 and 159,000. Total assets we have 663,000 2024 and 422,000 2023. Then we have equity and liabilities. We have ordinary share capital 400, and then we have 300 in 2023. Then we have retained earnings of 94,000 and then 42,000. We have accounts payable of 52,000 and 60,000. Then we have bonds payable of 90,000. Then we have income tax payable 12,000 and none in 2023. And then we have accrued expenses of 15,000 and 20,000. So we have total equity and liability of 663,000 for 2024, and then 422,000 for 2023. Then they have given us the statement of comprehensive incomes for the 31st December 2024. We have revenue from sales is 975,000. We have cost of goods sold, which is 660,000, giving us a gross profit of 315,000. Then less expenses, we have administration expenses of 176,000. Then we have depreciation of 18,000, and then loss on sale of equipment of 1,000. So it gives us 195,000. So when we subtract our gross profit minus the total expenses, we're going to get profit before tax as 120,000. Then income taxes were 36,000, and then profit for the year is 84,000. Then after that, we have additional information. They're telling us that dividends of 32,000 were declared and paid in cash. Then they're telling us bonds were issued at a fair value for Uganda shillings 90,000. Then equipment costing 180 was purchased for cash. Then they're telling us equipment costing 20,000 was sold for Uganda shillings 17,000 when its book value was 18,000. Common stock of 100,000 shillings was issued to acquire land. Required. Prepare a statement of cash flows in accordance with IS 7 using the indirect method. So that's the question that we are going to do. But then I told you that before we start the question, we can first make our cash analysis. Our cash analysis, we are going to look at the cash and cash equivalent at the start vis-a-vis cash and cash equivalent at the end. Now, in the question, if you check, they gave us cash of 191,000. So that means cash for 2024, or what you can call the closing balance, is 191,000. Okay, and then for 2023, which is our opening balance here, is 159,000. So meaning that our cash has moved from 159,000 in 2023 to 191,000 in 2024. So the difference in movement is 32,000. So this is a net increase, meaning that once we are doing our number, our final figure should be 32,000 as the net increase in cash and cash equivalent. Now, this is the analysis. That means that our answer should have this figure as the net increase. So we can start and say Havana Company Limited statement of cash flows for the period ended December 2024. So That's how we're going to start. Then, as we're starting, we're going to first bring our cash flows from operating activities. So we're going to say cash flows from operating activities. So we're going to put our UDX here and then our UDX here, our Uganda shillings. Now, here I say that the very first thing that we should bring should be the net profit before interest and tax. But then interest is not mandatory. But then tax, to every company should pay tax. So that means that they can either give you net profit before tax or net profit before interest and tax. Now, if you check in the question, they gave us an income statement, and that income statement they gave us profit before tax. That means they didn't give us interest to be paid in that period, not so. So it means that we only have taxes to be paid. So it means you're going to start with your profit before tax here. And now the profit before tax, if you check in our income statement, it's 120,000. So that's the profit before tax that we got. Always, it is always profit before tax. Now, after that, we are supposed to adjust the non-cash items. So we say adjustment of non-cash items. Now, adjustment of non-cash items, we are going to start with depreciation. Now, in the question, if you look at the income statement, luckily enough here, they gave us an income statement and they gave us depreciation of 18,000. So they told us that depreciation is 18,000. Now, depreciation can either be given to you in the income statement, or depreciation can be given to you in additional information. Or there are also some instances whereby depreciation might not be given to you, and you're supposed to calculate it using accumulated depreciation, meaning you can draw up a T account for accumulated depreciation to get how much depreciation was charged over the year. But here they have given us our depreciation, so we add back our depreciation, and if we check in the income statement, our depreciation is 18,000. That was our depreciation that we had. Then we said after depreciation, we can look out for any other element that should come here. So I told you once we have a gain or a loss on disposal. Now, if you check in additional information, they told us that equipment costing 20,000 was sold for 17 when its net book value was 18. So an equipment, okay, we sold it at 17,000. But they're telling us that the net book value of 18,000. So if its net book value is 18,000 and it was sold at 17, that means they made a loss of 1,000. Now, this is a loss on disposal. So if we check back in the income statement, under expenses, we have depreciation and then we have a loss on disposal of 1,000. Meaning that this loss of disposal of 1,000 has been deducted off our net profit in the income statement. So once it's a loss on disposal, I said we're supposed to add it back. So you come and say add our loss on disposal. And our loss on disposal is 1,000. So these are the only items that we have concerning the adjustment of non-cash items. So we're going to add 120,000 plus 18 plus 1,000, which gives you 139,000. So that's what we have, 139,000. Then after that, we go to changes in working capital. Changes in working capital. Now, when it comes to changes in working capital, if you check through the question, now in the question we have our receivables. Our receivables, we have 12,000. Let me start with inventory. Our inventory is actually 130,000 in 2024 and 160 in 2023. So it's like this. We have 160 in 2023, but then in 2024 it becomes 130. Meaning that this inventory was 160 the previous year. It is now 130,000. So it means, since it is reducing, it means we sold part of this inventory and now we have 130. The difference, which is 30,000, is going to become an inflow. So once our inventory is reducing, it means we are selling the inventory. So the 30,000 is going to become an inflow. So you come here and say decrease in inventory is 30,000. So I'm going to put 30,000 here to show that it is an inflow. That's what it means. Then after that, they're telling us that our accounts receivable, if you see in the question, our accounts receivable in 2020 were 15,000 and now we have 12,000. So meaning that is 15 and now we have 12. They were demanding us 15,000. Now they're demanding us 12,000. Okay, so we're demanding them 12,000. It means 2023 we are demanding them 15, 2024 we are demanding them 12. So that difference of 3,000 is what they paid us. Now because they paid us, this 3,000 becomes a cash inflow. So we say decrease in receivables. So the 3,000 becomes a cash inflow, like that. Then if we continue, we have prepaid expenses. Now if you look at the prepaid expenses, we have 8,000 in 2023 and then 6,000 in 2024. Still 8,000 2023, 6,000 2024. Meaning that once your prepaid expenses are reducing, it means you're retaining more money than you're giving out. So that means the 2,000 is going to become a cash inflow. But then if it was increasing, it means you are paying out more money. So it would have been a cash outflow. But then it is decreasing, meaning that you're retaining more money. So prepaid expense is decreasing, it becomes a cash inflow. So it's decrease in prepaid expenses. So it is decreasing by 2,000. So this 2,000 becomes a cash inflow. Then they are telling us that if you look at the accounts payable under liabilities and equity, accounts payable was 60,000. Okay. So our accounts payable was 60,000. Okay. Now in 2023 they were demanding us 60,000, but then in 2024 they're demanding us 54,000. So it means that if they're demanding us 60,000 and they're now demanding us 54,000, this is a reduction in the accounts payable. So it means since there is a reduction, it means, so it is 52,000. It means since there is a reduction in the accounts payable, actually we paid them 8,000. If they are demanding us 60 and now they're demanding us 52, it means we paid them part. So that's what reduced the 60 to 52. Now the reduction of 8,000 is what we're going to take as a cash outflow because we were paying them. So you can say decrease in payables. Decrease in payables. Now since we were paying them, the 8,000 is going to become a cash outflow because we were paying the creditors. Then still we have accrued expenses. Now our accrued expenses, if you look at them, we have 20,000 in 2023 and then we have 15,000 in 2024. So still they are demanding us 20,000. Now they're demanding us 15, meaning that difference of 5,000 is what we actually paid. Because if they're demanding us 20, it means we paid them 5,000 to bring the balance to 15,000. So this 5,000 becomes a cash outflow. So we say decrease in accrued expenses. So the decrease is 5,000. So that's the decrease that we are going to take. So after that, we are going to add up this. So we're going to add up this plus this plus this, then we subtract off this, and it will give us 161,000, and I will call it cash generated from operations. Cash generated from operations. That's how it has to be. Then we say that after getting the cash from operations, we're supposed to subtract off the tax paid and also the interest paid if it's there. Now, the tax paid here, if you look at the question very well, the tax paid, in the question, they gave us profit before tax. Then they gave us income taxes of 36,000. But then, if you look through the statement of financial position under equity and liabilities, they gave us income tax payable. It means we're supposed to make an adjustment by us drawing up an income tax account. Okay? So it means since the income tax that is supposed to be paid is payable, it means a liability. A liability has a normal credit balance. So our balance brought forward, if you check within the balance sheet, it is 0. So meaning we don't have any balance brought forward. But then the balance carried down, the one of 2024 is actually 12,000. Like this. We are only drawing up the T account for us to get how much tax was paid. So it means the balance brought forward was nothing, but then the balance carried down is 12,000. Now, if you check in the statement of profit or loss, our income taxes of 36,000 was subtracted, meaning that they are being recognized as expenses in the what? In the profit and loss. Now, once you debit the profit and loss, it means you're recognizing an expense. That's why that the income statement, and in the income statement, our profit, our income taxes were subtracted because it is an expense by the business. That means the corresponding account should be to bring that figure from the profit and loss account, which is 36,000. So it means I'm going to bring the income taxes from the profit and loss, which is the statement of financial, the statement of profit and loss, and then I'm going to credit it here. Then I'm going to balance off my account. I'll have 36,000 here, and then 36,000 here. Now, once I get this minus this, I'm going to get 24,000. Now, this 24,000 is going to become the tax paid. So, as much as income tax is 36,000, that's not what was actually paid. So, you want to see how much was paid. Now, how much was paid is the 24,000. So, it means I'm going to get the 24,000 and then subtract it from here. So, I'll call it tax paid. Now, since it's tax paid, I put it in brackets to show that money is actually going out. So, after that, we're going to have 137,000, and then you're going to call it net cash flows from operating activities. So, when it comes to the income taxes, even if there were interests, and the interest that we paid actually had interest payable, it means we're supposed to find out how much that was actually paid. Because here, I'm putting in consideration the accrual and prepayments. So meaning, we're supposed to establish how much was actually paid. So the tax paid is what we need because it's the amount of money that actually went out. Alright, so that's what we have there. Then, our next part is for us to go to the cash flows from investing activities. So still maintain our, so that's where we are now. Now, if you read through the question, they told us that equipment costing 180,000 was purchased for cash. Equipment costing 180,000 was purchased for cash. Now, when it comes to investing activities, we are looking at the sale and purchase of non-current assets. Now, they're telling us that there was a purchase of equipment, but the purchase of this equipment was worth 180,000. Now, since it is a purchase, it signifies that money is going out. So, because of that, I'm supposed to put it in brackets to show that it is a cash outflow. So, a purchase of equipment of 180,000, it should be shown here to show that money is actually going out. Then, still, part D, they're telling us that equipment costing 20,000 was sold for 17,000 when its book value was 18,000. Now, they are trying to tell us still here, yes, we had the purchase of equipment of 180, but that was not enough. We also sold an equipment, but then the equipment that we sold, once we sold it, we got 17,000. Now, here you don't need it's what? It's depreciation. You only need how much was realized from the sale of this equipment. So you're going to say proceeds from sale of equipment. Now, this equipment was sold for 17,000. Now, since once we sold this equipment, we received 17,000, meaning that the 17,000 is an inflow because it's coming in because we sold the equipment. Then there's something so important here. They said common stock of 100,000 shillings was issued to acquire land. Now, once we issue common stock, it means people are bringing in money to buy ordinary shares. But then, again, if we issued it, it means the amount of money that we got from common stock, we used it to acquire land. Now, this is the trick. They said common stock of 100,000 was issued to acquire land. It means common stock is an item of financing activities. But then, as much as it's an item of financing activities, once we issued it out, it means money came in. So that means we're supposed to recognize it under financing activities. But then again, when that money came in, that same money was used to acquire land. So meaning, we are going to say acquisition of land. Now, I'm bringing it here because land is a non-current asset. And because it's a non-current asset, that is purchase of land. So purchase of land signifies a cash outflow. So that's what we have concerning our investing activities. Now, once we are done with that, we are going to get 263,000, and then I'm going to call it net cash flows from investing activities. So that's why we are. But now this 263 is a negative balance. So it means that I have 180 and 100. This is 280, but it's a negative. Now I only have 17,000 as a positive, meaning the balance I'm going to get will be 263,000, which is a negative balance. Therefore, we'll continue to the next one. We have cash flows from financing activities. So the financing activities, if you take in the question, your additional information, the very first part A is saying that dividends of 32,000 were declared and paid in cash. So that means we are paying out dividends. So once you are paying out dividends, you say dividends paid. So you said dividends paid. So the dividends paid were worth 32,000. And now, since these dividends are being paid out, I should put them in brackets to show that it's a cash outflow. And then, in the same question, they're telling us that bonds were issued at a fair value for Ghana shillings 90,000. Now, once bonds are being issued out, it means actually we are receiving money. So once bonds are being issued out, we say issue of bonds. Now, once these bonds are being issued, it means we are actually receiving the money. So they're saying that they were issued at a fair value of 90,000. So it means we are receiving 90,000 cash coming into the business. Now, they can say bonds were issued or there's a payment. Okay, that's why you find that in the question here, in our balance sheet, we have bonds payable. It means they will be paid in the future time. But then here there's an issue of bonds, so it means money is coming into the business. Then, if you check here again, remember there was a common stock which was issued. Now that common stock, it was 100,000. Remember, we issued common stock of 100,000, but then we used that 100,000 to acquire land. Now, even if we use it to acquire land, it should come here to show that that money first came in before we use it to acquire land. So it means you're going to say common stock. And that common stock was 100,000. It was an inflow, meaning money came in through common stock, Okay, common stock, these are ordinary shares. So once the money came in, we used this 100,000 to purchase land. So I had to subtract it off here under investing activities because a non-current asset was being purchased. But then we're not supposed to neglect the fact that this money came in as common stock. So we're supposed to show the inflow and the outflow of it as well. So once we do this, we are going to get our 158,000 here, and then shall call it net cash flows from financing activities. So it means this is the net cash flows from the financing activities. Now, once you add this, okay, minus this plus this, our final figure is going to be 32,000. So which is the net increase? So we're going to say we have a net increase in cash and cash equivalent. Now, if you still recall, 32,000 was the first figure we got when we were starting under our cash analysis. Remember, it was 191,000 minus 159,000, and it gave us 32,000. So it means we have got our net increase in cash as 32,000, the figure that we established at first. So meaning that this figure actually makes up our net increase in cash and the cash equivalent. Then after that, we're supposed to add the opening balance of cash and cash equivalent. Now, our opening balance for cash and cash equivalents was 159,000. Okay? Now, this opening balance, once you add these two figures, the closing balance has to be 191,000. Now, this figure is the closing balance for cash and cash equivalent. So, if you check back in our balance sheet, we had 159 as the opening cash and 191 as the closing cash. So by us doing this, we have actually showed how cash has been moving in the business. So this is how the statement of cash flows looks like. Now, I'll try to get another video which is a bit broader to simplify some of the concepts here. Thank you so much for watching. This is Kevin Davis Accounting. Subscribe the channel, share to your friends, tell them also there's skill learning taking place here. Until we meet again, it's a bye for now.